Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial world of TPG Private Markets Fund by dissecting their recent SEC filing, which, spoiler alert, reads more like a recipe book on how to manage risks than a thrilling novel. But don't worry, because Corporate Decoder will turn it into a fascinating story. This filing outlines a new fund aiming to give everyday investors access to the complex world of private equity, usually reserved for the ultra-rich. We'll uncover how they plan to do it, the fees involved, and, most importantly, the potential risks. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more questions, comments, and feedback. Okay, so what is this filing anyway? It's a Form N2, which means TPG Private Markets Fund is registering as a non-diversified, closed-end management investment company. Basically, it's a new fund hitting the market. The fund's main goal is pretty straightforward: long-term capital growth, meaning they want to increase your money over time, but it's not guaranteed. They plan to achieve this by investing at least 80% of their money plus any borrowings into what they call investment interests. These investment interests are essentially private equity deals managed by TPG and Angelo Gordon with their affiliate groups. TPG isn't just a name, they're a massive player in the alternative asset game with $26 billion in assets under management as of the end of 2024. TPG plans to provide the fund with the kind of information that other institutional investors receive. TPG will not guarantee investment opportunities for the fund. Here is how to get into the game if you want to play along. You will need a minimum investment of $10,000, and there are sales loads, early repurchase fees, and other expenses. So remember to buckle up, and remember it's very illiquid, so you won't be able to easily sell your shares. Now let's talk numbers. There is a maximum sales load of 350%, which adds up to around $52 million. We will come back to sales loads because they are a major concern. Shares will be sold non-publicly, so don't expect to trade this on any exchange. If you are thinking of making this investment, if you try to get your money out before the 1-year mark, you'll be slapped with a 2% early repurchase fee. That money doesn't go to TPG, it stays in the fund for the other investors. Now, for acquired fund fees and expenses, they're talking about 1.119%. This covers the cost of running the investments within the investment interests. And remember that these expenses may be substantially higher if there are carried interest expenses. Here is something to lower your concern. The advisor has put a cap to limit specified expenses to 0.28% per year to protect each class of share. They have, however, excluded several types of fees. Adding everything together, the annual fund expenses come to 3.01% for Class A shares, 2.31% for Class I shares, and 2.01% for Class F shares. These are pretty high numbers, a bit wild, but after an expense reimbursement that the advisor offers, those numbers drop a little to 2.82%, 12%, and 1.82% respectively. Now, here is some Warren Buffett level analysis for your money. An investor in Class A shares will pay a sales load of up to 350% of the investment and 0.12% in offering expenses, so you are already down 3.76% just to start. So keep that in mind if paying those fees. What potential issues is the company highlighting? The company listed the following areas as risk factors, so always take note about being aware of them. We have the general economy, no prior business activities to point to, a very specific strategy to focus on a small field of investing with TPG, and you shouldn't expect the shares to have much liquidity at all. There is no secondary market that is expected for these class of shares to have much liquidity at all. There is no secondary market that is expected for these class of shares. They also admit to substantial fees and expenses with a potential that they might not even return enough to the investors to cover such expenses. I highly advise you understand the fees and how they work. Finally, to the risk of the relationship itself, there is no guarantee that the fund will receive the same terms as TPG, and TPG can terminate the funds interesting in the investment. It is important to emphasize that although a large of the investments may be allocated to investment internets managed or sponsored by TPG, TPG has no say in the advisor's process. So what's my take on this? TPG Private Markets Fund is trying to democratize access to private equity, but it comes with a hefty price tag. The high fees, especially the sales load that you need to pay just to get into the investment and illiquidity, are huge downsides. Also, too much reliance on a single point of contact for its investment interests. Hell, is this a good option for smaller investors? Hard to say. The world of private equity can be potentially high reward. The management fees are still pretty concerning, and the fund success is heavily tied to the performance of TPG investments. The fund structure is meant to lighten investor burdens. It introduces liquidity risks. Alright, that's our breakdown of TPG Private Markets Funds filing. What are your thoughts on this fund? Would you consider investing, or are the risks and fees too high? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description to continue the discussion. Thanks for watching, and I'll see you in the next video.